Today, I want to talk about a 100% automated daily algorithmic strategy that I've developed. It has shown impressive results over 6 years of backtesting on 5-minute candles for the NQ, covering nearly 3,500 trades. This strategy is designed to independently identify and trade the V-shape, which is a well-known chart pattern. It automatically enters the trade and places both the stop loss and take profit levels based on the current market volatility. Next, let's explain what a V-shaped formation actually is and why it's considered a bullish signal. A V-shaped recovery occurs when the market experiences a sharp, aggressive price decline, followed by an equally quick and strong move back to the upside. This rapid reversal creates the distinct V-shape on your chart. It is considered a highly bullish sign because it shows that despite a period of intense selling pressure, buyers stepped in aggressively and completely took control, rejecting the lower prices and driving the trend upward with significant momentum. Now, let's dive into how I define a V-shaped formation from an algorithmic perspective. The logic is simple and straightforward. First, I want to see the price move downward by a specific number of units, which I measure using the ATR, average true range. As it drops, the price must maintain a clear, consistent path without breaking its downward trajectory. Once that move is complete, I look for the exact same behavior in the opposite direction. As you can see on the screen, the yellow lines illustrate this perfectly. The algorithm tracks that controlled descent and then confirms the pattern when it sees an identical sharp recovery back to the upside. Furthermore, I also use the ATR to measure the width of the price path, essentially the corridor through which the price moves. This ensures that the price stays within a specific controlled range during the formation. To make this clearer, let's look at an example with actual numbers. Suppose the ATR is currently 10 points. If we define our corridor width as 1 times the ATR, the price must stay within a 10-point lane as it moves down and then back up. If the price swings too wide or drifts too far outside that 10-point range, the algorithm identifies that the pattern is no longer valid. Using these specific calculations helps us filter out market noise and focus only on clean, high-quality V-shaped setups. Now, let's move on to the part where we look at the strategy's entries and exits directly on the chart. For our first example, you can see right here that we have a V-shaped formation that met all of our algorithmic standards. As soon as the pattern was completed, I received a signal and entered the trade. We can also look at these 2 other examples here. One was a successful trade, while in the other one, we took a loss. Now, we're going to dive into the indicator code to show exactly how I define a V-shape. If you aren't a programmer, feel free to skip this section. But if you're interested in learning how to build things like this yourself, I do have a full course available. Let's start with a quick overview of the core parameters that drive the logic. First, we have the ATR period, which is the look-back period used for our volatility calculations. Next is the height multiplier, X. This defines the required vertical move in ATR units, basically how deep the drop and recovery need to be. Then we have the channel width, tolerance. As we discussed earlier, this is the corridor or maximum allowed deviation from the leg line, measured in ATR units. Finally, there is the max leg length, which sets the maximum number of bars the algorithm will look back to identify a single leg of the V-shape. Now, let's get into the brain of the indicator, the on-bar update function. This is where the actual logic happens on every single candle. I'll explain this in a way that's both technical and intuitive. First, the script does a quick safety check to ensure we have enough data for the ATR. Then, it calculates our 2 key thresholds, the min move, which is the minimum vertical distance required for a V, and the max channel width, which is that corridor we talked about earlier. The logic then works in 2 main steps. 1. Scanning for the trough. The code looks back through recent history up to the max leg length to find a trough, or the bottom of the V. It checks if the distance from the current high back down to that trough is large enough to meet our min move. If it is, it uses a helper function, isChannelValid, to make sure the price stayed within our narrow corridor on the way back up. 2. Scanning for the start peak. If the right side of the V looks good, the code then looks back even further from the trough to find the start peak, the beginning of the drop. It performs the same checks here. Is the drop deep enough? And did the price stay within the corridor on the way down? If both sides pass these tests, a V shape is found. The script then draws the pattern on your screen and fires off a bullish signal. It's a very systematic way of ensuring that what we see on the chart isn't just random noise, but a true, structured reversal. Now, let's move over to the strategy file itself. This part is actually quite elegant because the strategy simply acts on the signals generated by the indicator we just built. Let's look at the on-bar update function within the strategy to see how it handles execution. First, we have our standard check to ensure enough bars have passed to start trading. Then, the code checks if we are currently flat, meaning we don't have an open position. We only want to look for new entries when we aren't already in a trade. The magic happens in the next line. It checks the V-shape indicator. If the indicator fires a bullish signal, the strategy springs into action. It immediately pulls the current ATR value to calculate your risk and reward dynamically. Instead of using a fixed number of points, it sets the stop loss and profit target based on market volatility. For example, the stop price is set at a specific multiple of the ATR below your entry, and the target is set at a multiple above it. Once those levels are calculated and locked in, the command Enter Long is triggered, and the trade is live. This approach ensures that your exit strategy is always in sync with how the market is moving at that exact moment. That brings us to the end of this lesson. We've covered everything from the core concept of the V-shaped pattern to the technical logic of how the algorithm identifies it and manages trades using the ATR. By combining a classic chart pattern with automated volatility-based management, we take the emotion out of the equation and focus on consistent execution. I hope this gave you a clear look at how a 100% automated strategy operates from the inside out. Stay disciplined, keep analyzing the data, and I'll see you in the next one.